Good morning, everybody. Thank you very much indeed for joining me this morning, and thanks very much indeed to Professional Advisor for hosting us today. My name is Ben Conway, and I'm a Head of Fund Management at Hawksmoor Fund Managers, and we run a suite of 3 multi-asset funds with a track record of just over 12 years. Now, title of my presentation today is The Best Environment for Active Multi-Asset Investing for Decades. But before I go into the meat and bones of the presentation, I thought it was worth just pausing and making a few observations about the very nature of multi-asset investing and remembering what the point of it is. And for us, the point of the exercise, the point of why we do what we do, is to achieve the objectives of the end client. And that end client, of course, is your end client, and we never forget that. And what we never forget is what does that end client really care about? And for us, that is the pounds and pence on the statement from one period to the next. And is that pounds and pence amount growing in a sufficient manner? And I'll return a little bit later as to what growth in a sufficient manner within an investing context is. But the whole point is that investor relates to that amount rather than a quartile ranking or over cumulative or discrete periods, or whether it's under or outperforming a certain benchmark that client really cannot relate to. It's about that pounds and pence amount. And once you place that as at the paramount, at the forefront of your investment process, then we believe that some quite important connotations and conclusions stem from that. And I want to address some of those today. And the second point I want to make before we begin is that there are many ways to skin the multi-asset investment cat. And what I mean by that is that there are a whole host of processes, all of which have got their merits, but all of which, including our own, have their drawbacks. And I think that what I want to get across to you today is that it's beholden upon every single fund manager to recognize that their process isn't the silver bullet. Nobody has yet, as far as I'm aware, solved multi-asset investment. And the key is to have faith that your process will perform well through a market cycle and achieve that client objective. And I think a really good potential strategy, which I will go into, is for multi-asset investors is to blend different styles and to have several different processes that will perform well through market cycles, but do so at different times. So if I move on now to the learning objectives and what I want to get out through the course of this presentation today, and one is that I'd really love for us to understand the limitations of the traditional mainstream bond equity approach to multi-asset investing, particularly in the current environment. A lot of the points I'm going to make are actually going to chime very, very well with those made by Dan Kemp earlier, actually. Secondly, I want everybody to understand the benefits and drawbacks of a very active approach to asset allocation, which is our approach, which is looking beyond mainstream equities and bonds in the search of assets and investment in assets that can help with the client objective. Thirdly, I want to talk about how blending lower cost solutions that might be more passively oriented or more oriented towards direct securities or certain styles. I want to have blending those sorts of solutions with a much more active but unfortunately higher cost investment process has significant merits. And then lastly, I want to spend a little bit of time about talking about how active investing within asset classes, bond and equities, is primed to deliver very strong returns, although it's not guaranteed, but it's primed to deliver very strong returns from today after a few years of fairly lackluster performance from active managers. So here's our agenda today that I'm going to take you through over the next 20 odd minutes. I'll start with that client objective, and then I want to talk about the importance of valuation, because for us, valuation is a very, very important driver of returns. And as soon as you put the client objective at the forefront, we think it's beholden to fund managers to consider valuation. And I think once you do that, if you place valuation at the center of your investment process, you really got to consider investing in asset classes beyond mainstream equities and bonds. And then finally, I'll talk about that environment that I just mentioned for active managers and why it may be very, very good from here. So let's start with the client objective. As I mentioned, for us, every single day we invest, every time we do anything, we're always thinking about that client. And is the thing that we're investing in, is it going to contribute to that client objective? And our process is all about ensuring that we're constructing portfolios that have assets, each of which are contributing to that objective, but each of which is also supplying considerable diversification to the portfolio. So what we ideally want is a portfolio of assets that's very diversified, each one of which has a key margin of safety, i.e. Exhibits low valuation characteristics, because we know that at any one time we're never going to get everything right at any one time, so that when we are wrong in a particular asset over a period of time, we know that the downside is going to be somewhat limited, and at the same time the things that are performing well, because we've entered at a very, very good price, the upside is going to be far more than the prospective downside. So let's just delve into a little bit more detail about what I mean by the client objective. And I think Sir John Templeton put it very well. He's one of our investor heroes. He had several investment maxims, and we think this is the most important one of them. And he said, and I'll just read from the quote, "For all long-term investors, there is only one objective, and that is maximum total real return after taxes." And I've added there "and charges." He didn't mention that, but I think charges are extremely important. So what we do is we flip that on its head and we say, well, what's the minimum objective of any multi-asset solution? Well, of course, the minimum objective of any multi-asset solution is to grow the purchasing power of your client's wealth through time after the savage impact of taxes and other charges. And that is what we place at the center. That is what we view of the minimum objective of any of our strategies. But we recognize that charges are in many ways the only thing you can guarantee. We can't guarantee future performance, but of course we can guarantee charges. And our approach, unfortunately, is certainly more expensive than a lower cost passive solution. And we recognize, for example, that for every 1% more a client plays in terms of an OCF, over 10 years, that's going to be a 10.5% headwind to achieving that aim. That's really something that we must take seriously. And I think if we're going to ask our investors to pay a higher charge, then we have to really, really justify that. And I think that if you're going to look at higher cost solutions and more active solutions, then they better be very, very active and making use of all the tools at their disposal. And there can be no doubt that over the past 15 years, certainly, that the traditional approach, perhaps you can call it the lower cost approach to multi-asset investing, that just invests in mainstream bonds and equities, has served clients fantastically well. And this is a chart of a simple balanced construction: 60% equities, 40% mainstream bonds, going back to 2007. You can see how well it's done. Everybody knows that. The point is that it's not necessarily always going to be the case. And the reason that is simply the valuation of those assets. At some point, valuation, if it gets too high, would exert a downward force on prospective returns. And this is really where the importance of valuation comes in. As I said earlier, what's really important to us is that every single asset that we're putting into the portfolio does two things. One, diversifies, and two, contributes to the client objective, which necessitates that it has low valuation. So now I want to just explore some of the constituents of the mainstream the parts of the mainstream allocation, the mainstream approach to multi-asset investing. And of course, this is a chart you'll all be very familiar with. Nominal 10-year government bond yields across the UK, the US, and Germany. You'll all know how precipitously yields have fallen. But for us, it's simply a case of, well, if the yields on a fixed income investment are near zero, how on earth, after the impact of taxes and charges, how on earth are they going to contribute to the client objective? But it's more than that. Here I've got a chart of the yield on a broad index of US bonds. That's the orange line there. So you can see, again, yields are falling towards zero. And I've also got a measure of risk. Here I've chosen duration, which is the blue line. Duration is a measure of risk. It's the how prices of bonds react to changes in interest rates. And you can see that as these yields have fallen, the duration risk has increased. So it's not just the fact that these instruments are expensive, but they're also more risky. And I think it's always useful just to pause here and consider whether these particular instruments are going to provide diversification benefits. If they're not going to provide benefits in terms of contributing towards the client objective, well, will they offset equity market declines? And in the context of a 60-40 balanced portfolio construction, if the equity market were to correct, let's say 10%, then what does the 40% that's invested in bonds have to do to make up that shortfall? And finger in the air, back of the envelope calculations suggests that if that bond allocation had an average maturity of around 10 years, then the yields on that portfolio would have to fall by about 1.5% to offset a 10% correction in equities. And given where the starting level of yields on a fixed income portfolio currently are, I think that's a big ask. It's not necessary. It doesn't mean that it's not going to happen. The point is that the balance of probability suggests that that is potentially unlikely. And it's interesting, I think, and informative that over recent months, and for example, in the pandemic, you saw that bonds didn't necessarily provide, or the early pandemic didn't necessarily provide diversification benefits. And obviously, more recently, you've seen a backup in yields as equity markets have basically tracked sideways. And what of equities? You'll be, I'm sure, utterly bored of hearing how expensive US equities are. It's been the case for many, many years. Unsurprisingly, we also think US equities are expensive, but I think there's a lot of lazy arguments when it comes to regional market valuation. And I thought it's worth just very quickly spending a minute or two on how we judge equity markets when we're considering them regionally. And what I've got here is a sector neutral, cyclically adjusted PE of the US market going back through history. So what is that? Well, I mean, the US market should be more expensive than, for example, the UK market. And that is because the sector composition of the US is completely different. It's home to some fantastic high growing technology companies, and it's got higher weightings in those particular companies. It deserves to trade at premium valuations. So whenever you are comparing regional markets, you absolutely have to sector neutralize. You have to adjust for those sector composition benefits, which is what we do. We also like to choose longer term measures of valuation, which is why we use cyclically adjusted PEs. That reduces the timing benefits. I mean, valuation is never a good timing tool, but when you're using even longer term measures of valuation, it reduces the timing benefits even further. But the point is that by any measure, even after you've sector neutralized, the US is extremely expensive. And indeed, most regional equity markets, unfortunately, are also expensive at the moment. And so you've had 45 years of what's really been a golden age for investors in mainstream assets across equities and bonds. And I think this is really important context. Let's zoom right back out to the 1970s. And since the 1970s, equities have given you about 11% per annum return. And we know from the Barclays Equity Gilt study that over 120 odd years, equities have produced about 8% per annum returns. So the past 40 odd years has seen a 300 basis point premium to the long run trend in equities. And it's very, very unlikely that will continue. And that's, of course, represented in very high valuations. And of course, we all know about yields as well on fixed income investments. And back to the 1970s, UK gilts had yields in the mid-teens, and they've fallen all the way back towards zero. I think that just the simple point here again is that golden age is unlikely to be repeated. So here I'm just showing some work done by GMO, who are an asset allocation specialist in the US. And they just look at starting valuations across the whole host of or wider cross-section of the mainstream equities and bond areas. And you can see here that based on starting valuations, their forecasts for real returns, and real returns is, of course, what everybody should care about. It's after the impact of inflation. Those forecast real returns are deeply negative across the whole cross-section, with the exception of emerging market value stocks. So again, I think it's really worth just pausing and thinking about whether an investment in these sort of mainstream asset classes is going to have a high or low probability of achieving that client objective, which I spoke about at the opening. But I also think it's worth having a very high degree of humility and remembering that no investment process, as I said at the outset, is going to be right all the time. No investment process can outperform at every single period. And one of the big drawbacks, for example, of a process like ours, which concentrates on valuation, is that things can stay expensive for prolonged periods of time. And that's exactly what we've seen over the past couple of years. And the reason that is, and I think it's really important that we recognize why that is a number of very powerful structural forces, which I've put on this slide here, whether it be the taming of inflation by central banks, whether it be the rise of ESG investing, MiFID II, a whole host of things, technological progress, demographics, I could go on. A lot of these factors are really quite strong and as I said, they're structural in nature, which means they could be pervasive for some time. So I think it's really important to recognize that if that is going to be the case, then a strategy that continues to allocate to the more mainstream and expensive areas of markets may continue to do quite well, which is why I would never argue for a multi-asset investor such as the audience I'm speaking to today. It's why I would never argue for a wholesale switch from one process to another. So what do we do about that? Our process gives us the maximum opportunity set, the maximum ability to be able to access cheap assets. So we're not different for the sake of it. Indeed, if we could invest in mainstream asset classes that fit our process, and if they were cheap, we'd be delighted to do so. Unfortunately, for the reasons that I've just explained, generally speaking, mainstream asset classes are just too expensive, and we don't feel that helps with the underlying client objective over the long term. So what I'm going to show you on the next slide is the current asset allocation of our distribution fund, which is got a risk profile akin to the balance fund. Indeed, it's within our range. It is the fund that we say has the balanced risk profile, and I compare that to the asset allocation of the simple 60-40 equity bond mix. And there's a couple of things I want to show you and really bring out here. That because of our valuation driven approach, it necessitates that we've got far lower exposure to developed market equity, some 25%. And it's also not just the exposure, it's the nature of that exposure. The type of equities we're accessing are very, very different as well. And we've also got hardly anything in developed market bonds, which should be unsurprising to you. So again, big plus 20% different weighting there. So where we do have exposure, and we call them here real assets, got about 25% exposure to that real assets bucket. It's things like property, but it's not just property, it's infrastructure assets like energy storage, it's song royalties, it's ships, all of which we can access via appropriate vehicles. So I think it's worth now considering how we access these types of things. But first, just to go through the benefits of accessing those cheaper asset classes. The first is that they're cheaper. If we can access different asset classes, then the benefit that they're cheaper is obviously a significant one. They achieve better diversification. I mean, there's assets that we can access that the determinant of whose returns have really got nothing to do with the ebb and flow, for example, of macroeconomics and the type of currents that would affect mainstream equities and bonds. And we think it improves, most importantly, the alignment with the client objective. But there are clear drawbacks to this. The first is, unfortunately, it comes with extra cost. And I think it's one thing to suggest that one in a fund management team can invest in across equities and bonds, but it's quite another to expect them to directly invest in private equity, to own ships, to own buildings, to own a portfolio of song royalties. For that, we really do think it's important to outsource to best-in-class specialists. But with that comes extra management fees. But it also necessitates a particular knowledge, not just of smaller open-ended funds, but also of the closed-ended fund universe, investment trusts, which are the vehicle that enable us to get access to these alternative assets. And investment trusts themselves can be quite high-maintenance little beasts. They have their own drawbacks. The first one is very clear, and that is a commercial one. It means that the investment trusts themselves can be small and can be illiquid, which means that if we want to continue to make these sorts of assets significant weights in our portfolios, there's no way that our process is as scalable as many of the other fine fund managers that you'll be hearing through over the next couple of days. So from a commercial angle, unfortunately for Hawksmoor's fund managers, shareholders, it means that there's no way we can run the billions and billions that other investment processes can. We're very comfortable with that, and that's something that we will manage, but it's certainly the one thing we're not prepared to sacrifice is the principles of our process and indeed the client objective. So that's something that as we grow, we will absolutely be looking to manage. And the other thing as well is the volatility of investment trusts. It's great that the assets that we can access via investment trusts display fantastic characteristics, and that's their net asset value of that portfolio. But unfortunately, investors in investment trusts get the share price, and that share price can dislocate from the net asset value for quite prolonged periods of time. So you have to be able to manage that, and you can manage that via portfolio construction, via position size, but you can also turn that to your advantage as we do, which is to invest in some of these asset classes at significant discounts to net asset value. So you can turn that to your advantage and provide an extra source of alpha for your investors. I want to move on now to active management within asset classes. I've spoken mainly about active management at the asset allocation level, but I think there's also a very strong case to be made for strong returns from active managers, equities and bonds, for example, within asset classes. So one of the drawbacks of lower cost passive orientated solutions is concentration risk, which is something that Dan spoke of first thing this morning. It's not always the case. Indices, the composition of indices ebb and flow through time. But right now, as Dan mentioned, a concentration, for example, in US equities via the S&P 500 is extremely high. And it could mean that a supposedly diversified multi-asset solution that has high weightings to a passively oriented index could have quite high weightings in a couple of US stocks. That's not necessarily a problem, but it is if those particular stocks are very highly valued, as we believe is the case today. But the flip side of that is, even if there's very high concentration that's leading to very expensive valuations at the index level, we can find active managers that can construct portfolios that are very, very cheap. And this is a function of valuation dispersion. And valuation dispersion occurs when you have bifurcation in markets, when there's a huge stampede towards a particular group of stocks and another particular group of stocks gets completely ignored. What this is not, and I want to stress, this is not the quality or growth versus value debate. And I just want to spend a minute on that. The quality versus the value debate, or growth versus value debate rather, I think is quite hackneyed, and in many ways is quite lazily argued. What this chart shows is the valuation in terms of PE of these factors through time. Look, we can see that growth has got very expensive. Again, you'll know that. And value looks cheap relative to it. Two things to mention. Yes, a value looks cheap relative to it, but it always does. That's the point of value. It's especially cheap now because of how expensive growth has got. Fine. But let's look at the same chart and let's imagine that those red and green lines weren't on there and they've just got that one factor on it. Well, value relative to its own history in absolute terms is also expensive. So I think that you've got to characterize the value versus growth debate. It's only can be couched in relative terms, and that if you just want to blindly follow the value factor, you may perform quite well in relative terms, but will it necessarily help you with a client objective? No, because it's expensive relative to its own history. So what I'm not arguing for is that we're just, when we're looking at active managers, we're just wholesale piling into those with a value style. We're looking for managers who are taking advantage of this dispersion. And what this chart here shows is the degree of valuation dispersion in the UK market. I think the UK market is is sort of fairish value, bit cheap maybe relative to other markets, but it's not stunningly cheap relative to its own history. But what it does show is this high degree of valuation dispersion, which is the fact that the PEs of the PEs of the cheapest segment of the market are very cheap versus the PEs of the most expensive part of the market, and you can see that valuation dispersion falling very, very quickly over the past 2 years. So it means that the opportunity set for truly active managers is very high, and that's exactly what we're seeing. We can get access to managers who are taking advantage of this and have a very cheap portfolios full of idiosyncratic risk that are not necessarily bent towards a value style. So, conscious of time, I want to round off by concluding and saying how I think I've demonstrated that both cost and valuation matter. And if you put valuation at the forefront of your mind, you've got to look outside the mainstream asset classes. There is no single right approach to multi-asset investing. We respect many different approaches, but perhaps it's worth considering a blend. And if you're going to blend, make sure you align yourself with managers with a robust, disciplined process. Perhaps if you're going towards the low cost end, make sure it's very low cost. And if you're going to go towards the higher cost end, make sure the process is very, very active and has clear advantages and edges. So there's our learning objectives, which we've gone through today. I hope you can see that in the short time we've had, we've at least touched upon a lot of these very important concepts. So it only leaves me to say thank you very much indeed for listening. I really do appreciate it. If you'd like to join me for Q&A at the end of the speaker session, that'd be fab. Or indeed in the room, the virtual chat rooms being hosted by my colleagues Hannah and David. I've got David's details there. So look forward to hearing your questions later on. Thank you very much.